that now. And this webinar will be available after, after this evening. So if you need to come back and, revisit it, or if you want to send it to a friend, it'll be available on our website. So before we get started, we just want to make sure everyone is set up properly on Zoom. So we're going to go over, how to make sure you're seeing us and hearing us okay, and what to do if you have a question. So if you're on a desktop, your audio controls will be in the lower left-hand portion of your screen, as you can see here. So just make sure you selected the appropriate option. If you're on mobile, your audio controls will be up in the left corner. And then your communication controls will be at the bottom. For the purposes of this webinar, we won't be taking questions live where you can ask the question on video or audio. We'll be using the Q&A widget to ask questions or to field your questions. So where that lives is on the bottom of your screen. Just go ahead and type your question, and we'll either answer it live during the presentation, or we'll answer it at the end. If for whatever reason we don't have time to answer your question, then we'll go ahead and make sure that we reach out and email you with an answer. But that's basically it. So that being said, I'm going to go ahead and hand it over to Jeff Hudson, who is our AVP of Real Estate Sales. And take it away, Jeff.
Thanks, Tatiana. Good evening, everyone. We're thrilled that you could join us for a little while this evening. Just a bit about San Francisco Fire Credit Union. We were founded in 1951 by firefighters, for firefighters. However, the credit union has grown over the years and now are focused not only on the needs of firefighters, but of the entire community. We realize there are many home lenders out there, and it can sometimes seem bewildering to understand the difference between one lender and the next, other than who is offering the lowest interest rate. So a couple things that might be helpful to know about San Francisco Fire Credit Union is that we're local, and the entire team that works on your loan is local. And that means we understand many of the unique aspects associated with owning a home in the Bay Area. Another thing that's important to know is we're a portfolio lender, which, without going into a lot of detail, just gives us a degree of flexibility that other lenders don't have. So our goal for the evening is to hopefully share some information and some key elements to both purchasing and financing a home, so you can be as prepared as possible for the home buying process. And with that, I'd like to go ahead and introduce our Master of Ceremonies for the evening, our Vice President of Real Estate, Michelle Murphy.
Thank you so much, Jeff. We get a number of questions that come up from borrowers that want to buy in the Bay Area, but they're intimidated by the process. And one of the recurring themes that we've had from questions, even when I bump into a friend at the grocery store, it's gosh, I simply can't buy in the Bay Area because it's too expensive. What they think they know about conforming loan amounts and what a jumbo loan is, maybe just what they've been told by friends and family in the past isn't necessarily true, and it's not necessarily linear from lender to lender. So I wanted to be able to take a moment just to talk about what a jumbo loan is, and just to give some advice and let people know that it's not necessarily as restrictive as everybody thinks it is. So let's talk a little bit about what is a jumbo loan, what is a conforming loan, and where those distinctions are. So you may have heard the phrase bantered around a conforming loan limit. That is simply the loan amount that's set by the FHFA, which is the Federal Housing Finance Administration. Every year they take a look to see on average what properties are selling for throughout the country, and then they set what those loan limits are so that they can pool these loans with people like Fannie Mae, Freddie Mac. And we can get into that a little bit more. And typically those amounts go up. In my history, in my career, I've only seen them stay flat for a period of time during the mortgage meltdown, but typically they increase. Currently, a conforming loan limit is $548,250. The FHFA just announced the new limits for 2022, and it bumped up by about $100,000. But even with that, if you're looking to buy a property in the Bay Area, even if you're going up to, let's say, a $647,000 conforming loan limit, that's still not going to get you close to the kind of loan amount that you'd need to get into a jumbo loan or a property within the Bay Area. There are also high balance loan amounts, and so that takes into consideration areas like the Bay Area where things do sell for more. And so there's a ramp up with that the loan amount change. That was previously $822,000. It was recently announced that could go as high as $970,000. But again, still in the Bay Area, that's, even if you did maxed out on a high balance loan limit, that's going to bring you far below the financing that you'd need to buy a property within the Bay, buy an average property within the Bay Area. And so that gets us into what a jumbo loan is. Literally all a jumbo loan means is a loan amount that's outside of either of those two categories, something that's higher than a conforming or a high balance loan. And what you need to know with that is that can vary county to county. So something like a high balance loan, for example, is only in those high cost areas. If you were buying outside of a high cost area, at $1 above conforming would put you into a jumbo loan. The nice thing about jumbo loans is that's where we have what's called portfolio pricing and portfolio underwriting. So us as a lender, as SFI, we take a look at knowing what our market is, knowing what those needs of our borrowers are, and we say great. Most of our borrowers are going to need a jumbo loan. What can we do to serve those borrowers' needs? Let's talk a little bit about what property values and what sales prices are in the Bay Area. We have a market update. This was presented by the California Association of Realtors. These are the statistics that came out effective of September, I believe. And what you're seeing here is based on the entire Bay Area, but for our 3 counties that we have a community membership, which is San Mateo, San Francisco, and Marin counties. Those 3, as you'll notice from this, are the 3 highest priced selling properties within the Bay Area. The average of those 3 is 1.4 million. So if we're talking, let's go back to that high balance loan limit. Even with that loan amount going, recently being increased to go as high as $970,000. If you were to buy an average home in one of our 3 counties, that means that you would still have to bring in a down payment of almost $500,000 to be able to get in on one of those loans. That's why jumbo financing is truly important. So let's
Michelle,
yes.
we do have a question that came in that I think is really relevant to the slides that you just covered. So I figured we could answer it live. So the question is the $548,250 the conforming loan limit in the Bay Area?
It is. The 548,200 or 250, I believe, is current as of today for the entire country. We are fortunate in that we are in what's called a high balance area. So that can take, it's a slightly separate category. It's usually priced a little bit higher. And it has a couple of additional restrictions so we would be in the Bay Area in a high balance area. So those loans could go as high as 822,000 currently. Going into 2022, that would be 970,000.
Gotcha.
But great question. Now you
Yeah.
can always take advantage of a conforming loan amount, a high balance loan amount, if you don't need that high of a loan amount for financing. But there are pricing tiers that go with conforming, with high balance, and with jumbos. They're each a little bit different. Thank you. The great question. Let's I think we've got a couple of poll questions for our viewers.
Yes, we do. So I'm going to go ahead and launch the poll questions. I'll go ahead and read them out loud. We have 4 of them. So they are, so these are true or false questions. So we want you guys to guess if these are true or false statements. Jumbo loans have always have higher interest rates than conforming or high balance loans. Number 2 is, with such a large balance loan, you need to have at least 30% ready for a down payment when looking in the Bay Area. Number 3 is, you can refinance to pull out cash on jumbo loans. And number 4 is, closing costs on a jumbo loan are always higher than other home loans. So go ahead and make your selections. Okay, thank you, everyone. So we'll go ahead and share the results. So it looks like for number 1, the majority of you guessed that this is a true statement. And we're going to be going over these in the upcoming slides as well. For number 2, everyone guessed false. Number 3, everyone guessed true. And number 4, everyone guessed false. So it's just number 1 that we had a couple different opinions. So Michelle, so we'll go ahead and go into what the answers are.
I was actually really excited to see that 2/3 of the pollsters, thought that this was true. And the reason I'm happy to see that is because I'm a big fan of Mythbusters, and I'm happy to bust this myth. The answer is false, and where this falls is it's not an always. With a lot of lenders, it can happen. A lot of lenders do price their jumbos higher. They're considered a higher risk. There's more exposure to the lender with tying up that much money with an interest rate. And if something goes bad with the loan, they want to make sure they're protected, and they do that by having a slightly higher interest rate on those. And that's where this is a false when it comes to SFI or credit union. We do not price our jumbo loans higher. In many situations, depending on how that loan is structured, you may have a lower interest rate than, for example, one of our high balance loans. And we can get into some specific details with that. So I'm happy to bust that myth. Although there are a number of jumbo loans and a number of jumbo lenders out there that make it a little more difficult for you to get into that property, requiring higher interest rates, which makes it harder to qualify for a little less house, require bigger down payments. That's not necessarily true with SFI. We've purposefully reviewed the products that we offer so that it appeals to the people within our membership and the people that are buying within our neighborhood. So that was exciting to see that I can bust that myth and make it a false. I believe the second myth we had, this was also very exciting, that the pollsters did not categorically believe that they had to have 30% down. When I've got on there, in quotes, I need 30% down to purchase in the Bay Area, that is a specific quote that I pulled pulled off of the Google, where people were talking about reasons that they were not believing that they could afford to buy in the Bay Area. They're like, I don't, if a property is selling for $1.4 million and I need 30% down, I'm never going to be able to save that much money. And that's a lot of money to save. In truth, you don't need to save a full 30% plus reserves, and we'll talk about what reserves are. plus reserves plus closing costs to get into a property. So I'm glad to know that that is false. Glad to hear that our pollsters recognize that that was a false statement as well. So good job. In truth, on whether it's a conforming loan or a jumbo loan, SF Fire offers products up to 95% financing, and that may scare little people. You may have heard that that oh gosh, if I don't have 20% down, for example, I have to have mortgage insurance, and I'm going to have it forever, and it's going to be expensive. You know, yes, you may have to have mortgage insurance, um, but that's a wonderful shopping tool, particularly when you're looking in the Bay Area, because it will let you get into a property sooner than you would by saving a full 20%. And what's different about what's called private mortgage insurance, which is what you can access through a lender like SF Fire, as opposed to a government loan like an FHA loan. An FHA loan, the government subsidized insurance that goes on there, and again, that insurance protects only the lender, does not protect the borrower. On an FHA loan, that is the one that sticks around forever. If you do an FHA loan, that type of mortgage insurance is going to be around for a minimum of 9 years. Private mortgage insurance is a little bit different. You can get into a property with as little as 5% down, up to $1 million loan amount, and with that, once you've paid down that mortgage organically to below an 80% loan to value, that mortgage insurance automatically drops off. Even better, if you're in that property and you've made your payments on time for 2 years and you've seen your property appreciate to the point that you've got enough equity in it, you can then request an appraisal and use that appraisal to request that mortgage insurance to be removed, because the lender no longer sees that as a high risk. So you can lock in a low interest rate, not have to worry about refinancing to get out of that loan, like you would have to do if you were on a government finance loan. So don't be afraid of mortgage insurance. Wanted to talk a little bit about what a super jumbo is. Now, this is where we do start talking about that 30% down payment, and this may not be for first-time home buyers. This might be for somebody who is selling and buying up, getting a larger property. And we've done loans, well, we state that we'll do loans up to 2.5 million. We, as a portfolio lender, we will often exceed that if it makes sense for that transaction. We have one right now that's about 3.2, I believe. And so we can assist borrowers if they're purchasing up to, $4 or $5 million on a property. Those larger loans, once you get above 1.5 million, once you get above 2.5 million, yes, you're going to be looking at a 30% down payment. But again, that type of loan is available for that criteria of borrower. So don't be afraid of that either. We have financing for that as well. One more myth. I've got a couple more. Do we not? Talked a little bit about mortgage insurance. One of the benefits of mortgage insurance, by the way, and I wanted to talk a little bit about home appreciation. One of the reasons people want to buy now rather than later, particularly for first-time home buyers, and why mortgage insurance is a great tool to use in that purchase, is you're not going to have to worry about, you can get into a property sooner without having saved that full 20% down payment. You don't have to worry about your landlord continuing to raise your rents, and you can get into that. And one of the differences with SF Fire Credit Union being a credit union is we have lower mortgage insurance rates than some of the big bank lenders. The mortgage insurance companies, being private mortgage insurance companies, recognize that our borrowers that come to us are lower risk, and our borrowers are then rewarded with lower rates to get into that. And so it will absolutely help you get into a property sooner rather than later. Moving on. In this particular this question, I can't pull cash out on a jumbo loan. So this speaks to the fact that jumbo loans are not just for home buyers. These loans are available for properties that you may already own and are looking to refinance. There is a commonly held misbelief that gosh, because I'm not, a conforming loan limit or a high balance loan limit, I can't do a cash out loan. And that's not true. We have loans available for borrowers um, in that $1 million, $1.55 million and up category where our borrowers do pull cash out and do so with a jumbo mortgage. Um, on top of that, we do not charge a higher interest rate for a cash out mortgage. We have a number of borrowers that utilize their properties to pull out some equity with a jumbo loan, take cash out, do some of those big home improvement projects that they've been wanting to do. They may have a child going off to college, pull money out and pay for that college financing, or even buy a property down where their child is going to school at, buy a second home or investment property. It's very common for our borrowers to do this. But what I find is borrowers are often afraid to even ask the question because they assume that because they've got a high loan amount that this is not a tool that's available for them. And I'm here to tell you that it is available for you and we can do it at a great interest rate and some really good loan terms as well. So let's see. What else have we got? Getting ready to buy. So there's a couple of things to know about this. What should you do to get ready to to really start looking for a property to start buying a property? And there's a few steps to this process. Let's talk about step one. I'm gonna simplify it as much as possible. It is a very complicated process when you're buying. It's one of the largest investments you're ever going to make. So please know that when I cover this stuff, I'm just covering the highlights of it. We've got loan professionals like Grady, who I have on the call today, that can answer some more in-depth questions, that can walk you through it in some detail. But in a nutshell, the first step is really making sure you've got your assets squared away. So do you have enough money for a down payment? And again, this speaks to, can you get into a loan with as little as 5% down, possibly 10% down? Do you have enough saved for that down payment? Do you have enough saved for closing costs? And we'll talk a little bit about that as well. And those closing costs can vary depending on the size of the home you're purchasing, and also where you're purchasing the home. And then also you're going to want to have a little bit of money set away for what they call reserves, and that's simply a payment cushion. And typically we're looking for about 2 months reserves. Depending on the loan product, you may need a little bit less, you may need a little bit more, but we want to make sure that you've got your money ready to go before you start shopping. And one of those pieces is once we do get you qualified, we're going to be careful when we're looking at your assets. Don't move the money around. Once we've got your assets verified, you've got don't think it's a good idea to move your money from whether it's SFI or credit union or Bank of America or Chase. Hey, I can get an extra 0.5% on a CD if I move it over there for the next 30 days. Don't do that. keep your money in one place once we've got it verified. And that way, once you go shopping, you're not going to hit any roadblocks as you go through. Step number 2, as you're working through, can we go ahead and advance? There we go. Is getting pre-approved, and this is where you'll be partnered with somebody like Grady, and particularly on a jumbo loan, this is such an important piece of the process. What a loan officer will do with you is go over with a fine-tooth comb. They will evaluate your credit report. They will evaluate the assets that you have available, where those assets are, if they're liquid, if they are not liquid, how much you need to close the loan, and then also what your income looks like. All of that will be taken into consideration and evaluated. There's 3 major parts to any loan, and it's heavily weighted from the income standpoint. So we want to make sure that we're qualifying you with the payment that you're going to be able to afford and have you be successful in that property. So that is the I won't say the first step, but that is the most important step in on your home purchasing journey, is to get pre-qualified. And then what we'd want to talk about, if we could please advance, is finding out what kind of loan is right for you. And this is something that your loan officer will work with you as well. But I wanted to be able to cover a couple of the different types of loan products. You know, most people are very familiar with the loan that their parents had, that their grandparents had. It's still our most frequently requested loan product, which is the 30-year fixed loan. It's got a nice stable payment. You never have to worry about it changing. And then there's also adjustable rate mortgages. What I will tell people is don't be afraid of an adjustable rate mortgage. These are the loans, the adjustable rate mortgages that are being offered today, particularly the ones that are being offered by SFI or credit union. These are not those scary ones where your payment is going to go up overnight and double, and get, prevent you from being able to afford that housing payment. Adjustable rate mortgages, the way that they work is they have a fixed period of time, where the loan is partially fixed, and at the end of that fixed period time, then the loan can adjust one time per year. But even with that, there's caps, so it can only adjust to a certain percentage. So it's tied to an index, something like the 1-year treasury or the 10-year treasury, for example. And then there's a small margin attached to that. At the end of that fixed rate period, that's when it will look out and say, gosh, here's what that payment would adjust to. But even with that, it's going to prevent it from jumping to a crazy high amount. It could never go up higher than, for example, 5% above where you started, never more than 2% per year, thereafter, and never more than 5% above where you started over the entire lifetime of the loan. So for example, you're not going to start off at let's say a 3% interest rate and go to like a 12% interest rate ever. It's never going to go that high. Now, one thing you should know about the difference between fixed rate mortgages and adjustable rate mortgages, and we offer jumbos on both of these options, is the highest rate you are ever going to pay is on whatever the longest fixed rate term is, because you're buying that interest rate risk. You're buying the security of that interest rate. So that being said, the highest rate you're going to pay and the highest mortgage payment you're going to have associated with that rate is that 30-year fixed rate mortgage. And here's the spoiler: almost none of our borrowers within the Bay Area, and I'm not saying that just as with the credit union, this is normalized throughout the entire Bay Area. People do not keep their mortgages for more than 6 years on average. It is highly unusual that whatever loan you get in when you are buying your home, that you're still going to have that mortgage 7 to 10 years from now. And if you can get a lower interest rate during that period and your payment is lower, you can save tens of thousands of dollars by looking at an adjustable rate mortgage, particularly when you're looking at those big jumbo loans. So don't rule it out. Don't be afraid of them, and feel free to have an open conversation with what loan is right for you when you're talking with your loan officer. I wanted to talk a little bit about the couple of different kinds of adjustable rate mortgages that we offer at the credit union. And they really break down into two separate categories. They're the really conservative ones where they have the longer fixed rate period. And so you'll see on the 10-1 and the 7-1, all that means is the 10-1, that interest rate is fixed for a full 10 years. That mortgage rate will not change for a full 10 years. At the end of that 10 years, it can change one time per year after that. So if any time before that you have most people will even sell their house and move during that time. But if you refinance to pull cash out, if you refinance to choose a different product, or if you sell, you are never going to have to worry about that rate adjusting, even if it's going to be a small, modest adjustment. So the conservative ones are the 7 and 10-year loans, because again, you likely will not have that mortgage product during that, but it still stretches that payment out, and you don't have to worry about that payment adjusting during that period of time. The products that are a little bit less conservative are the 5/1 and the 3/1, and again, I only call those less conservative because there's a likelihood that you're going to want to move out of this particular type of product before then. We see a lot of our borrowers who maybe are buying a condo in the city, and again, a condo in the city, and I'll let Norleen talk a little bit about that. But I mean, still, those property sales prices are well over $1 million. Somebody buying their first home in the city could probably get into a condo, have their payment be nice and low, but they know buying that they are not going to stay in that house forever. They're like, I'm going to live here for a couple years. We're getting married. We're going to start a family. We're going to move to the suburbs. But they want to get out of a rental situation. Something like a 3/1 or a 5/1 adjustable, knowing that they're only going to be there for a couple years, is a fantastic product. None of these loans have what's called a prepayment penalty, where if I decide to sell or refinance before this 5-year period up, there's no gotcha with it. Still great loans for home buyers. I myself have a 10/1 on my property, so I'm a big fan of the adjustable rate mortgages and wanted to be able to share that with you. Going forward, now, if you're purchasing, the next step, the step 3 is probably, I won't say the most important piece, because it is I cannot underestimate the huge importance of getting pre-approved before you start this process. But equally important is how you select a realtor. I don't mean to be callous when I say this, but I think it's fair to say that everybody on this call, certainly everybody I've talked to about this situation, knows somebody who's a realtor. There's a wide swath of talent when it comes to that. Everybody has a brother-in-law or a cousin or a friend of a neighbor who just got their real estate license, and they want to be able to help them out, and throw them a little business. I'm here to tell you, not everything is created equal, particularly in the Bay Area. Realtors know one another. You have people who have been in this business for a long time, who really understand the market, what is going to be accepted on a contract, and really can assist you with how that will be handled. The other piece for purchasing that I would tell you to be cognizant of, there are a lot of times where a realtor may recommend to have a shorter term escrow, but as you're planning your search, plan on that process, once you get into contract, taking approximately 30 days. It is certainly possible to close a loan sooner. We've closed loans in as little as 20 days. But on average in the Bay Area, it takes about 30 days to close an escrow. So give yourself the time to look for the right property and work that into your time frame as you're going forward. Now, as we're talking about selecting realtors, I'm really happy to be able to share who some of our business partners are. Working with the credit union, we have a service that's free to our membership called Home Advantage. And so I'm pleased to introduce Mark Dolby, who will talk a little bit about what that program is and how it can benefit our borrowers. But what I want to preface to say is before I transition over to him, is one of the things I talked about is how much money you need to get into a property. We talked about the down payment. We talked about reserves. We also talked about closing costs. And there's a number of ways that those closing costs can be offset. you could certainly try to ask for a seller credit. In this crazy market, you're probably not going to get it, and just simply asking for it may prevent that contract from being accepted for you. However, with something like Home Advantage, that service is free to you. That can help you cover the closing costs when you get in. So I'm pleased to introduce Mark Dolby, who's our partner with Home Advantage. Mark, if you would please.
Hey, thank you so much. I appreciate that, Michelle. And yeah, Home Advantage, it's a free member benefit. I think it's a fantastic tool for all members. So what are we? Home Advantage is really just kind of a turnkey real estate platform for credit unions. We were created in order to help credit union members save money when they buy and sell real estate, and we're owned by credit unions. And so we're really just here to help serve credit union members. We're installed in 150 or so credit unions across the nation. So if you are moving somewhere, the program can typically help you wherever you're going throughout the United States. Let's go to the next slide. All right, so what are the main features of the program that are really here to help you? One is a web portal. So you have a private MLS portal available to you as a credit union member here, where you can search for homes, you get home valuations, and you can do it all within the credit union. So you're insulated, none of your information is being sold. When you go to Zillow, Realtor.com, things like that, you have a tendency to get a lot of emails. So you actually have a great home search tool right here at the credit union through Home Advantage. So that's a great tool. We have a network of certified agents. In fact, we have one here with us, Norlene, and she's going to talk here in a minute. She's a superstar, but we have professional agents who have been in the business quite a while. And then really most importantly is there's a really nice cash reward when you use the program. Can offset these larger cash reserves for purchases, things like, or for jumbo loans. So the cash reward is a huge piece of it also. So let's move on. So the web portal, like I said, it gives you the ability to search homes without your information being marketed. So I think that's great. You can save properties. You can search for homes in a certain way where it feeds you homes in a certain zip code. So it's really intuitive. I urge you to go check it out. It's free for you to get registered in Home Advantage. Gives you a lot of great information on the web portal. Most important is really the agent. The agents in our network are all been in the business 15 years. We have roughly 730 agents nationwide. They're all full-time agents. They're all professional full-time agents. I think Michelle talked about there's a lot of part-time agents. Ours are all full-time agents, transacted a lot of business, been through a lot of ups and downs in industries and so on. So they're all managed by us, Home Advantage. So we have an agent services department that works closely. And I think one of the great things about our agents, they're not there to just say, hey, are you pre-approved? They're there to help nurture you and answer questions. And that's one of the different things about our agents in the program is they're really there to help you on your journey to home ownership, and not just necessarily try and get you pre-approved and get you out looking at homes. So the agents are fantastic to work with. You're going to talk to one here in a minute. Let's go to the next slide. This is a great piece. It's the cash reward. When we start talking about a jumbo loan, for example, we have a $1.5 million sales price here. You could get a cash reward of $9,000. Let's say you bought a home and sold a home around the same price. You'd get $9,000 twice. There's no cap to that. So it's all based on the purchase price of the home. It's a piece of the agent's commission. And that comes back to you as a credit union member. So it can really help you offset whatever you have going on, whether you need to do work to a home that you're trying to buy. But the cash reward is just a fantastic way to offset your costs on a lot of these big jumbo loans. So I'll introduce Norlene here. Norlene is one of our agents. She's fantastic. And Norlene, why don't you go ahead and speak about yourself a little bit and tell them about the market.
Oh, Norlene, be sure to unmute. There you go.
Thank you so much. Thank you so much. Thank you, Mark. Thank you, Michelle, and the rest of the SF Fire Credit Union team. We're extremely honored to partner with San Francisco Fire Credit Union. And a little bit about myself. I have been in the business full-time for over 18 years and started my career with a large brokerage. I live in San Francisco, bought my first home in Elk Grove, Sacramento, and spent my high school years in Pinole. A few years ago, I became a broker, opening Clarin Realty, and have seen and lived through the previous real estate cycle that we cautiously refer to. A little bit of challenges in the market I'd like to talk about. Going into the next slide. Last year, staying home became a necessity, and that caused many homeowners to have renewed gratitude for the roof over their head. 64% in the next slide has said that their home has been more important to them than ever, being able to live through the pandemic, representing safety and security. The residential migration, as people continue to work from home, have sought home life work balance needs. And as a result, buyers face some challenges in getting priced out and getting an offer accepted. The demand remains strong, definitely in the Bay Area, especially as single family home properties still don't stay on the market for very long. For example, 13 days from listing to contract versus 18 days a year ago from just November alone. And for condos, a sign of bouncing back, 25 days from listing to contract versus 42 days from listing to contract acceptance from a year ago just for November. This demand and the lack of inventory is challenging to many buyers, as most buyers look at the price of a property and think, how much over do I need to bid on this home to get it? And that can be quite exhausting at the same time. So it's important to have strategies in place to help. The strategies to get into contract or getting an offer accepted requires teamwork in both the lender and the realtor. We need to strategize your offer, and our job is to be able to determine what it would take to get the home within the parameters of your financial approval. I want to stress again, since we would need to potentially act fast, it's important to get pre-approved, as Michelle reiterated over and over again. It's important to decide, for example, in most cases, if your maximum purchase price is $1 million, do we need to look for homes up to $850,000 to allow you the room to negotiate? How aggressive do we need to be with our terms, contingencies? Can we minimize the days of those terms? Should we increase the initial deposit to make our offer stand out? Or is there an offer due date? Or can we make what you call a preemptive offer? All of these can potentially help in getting your offer accepted. And in terms of home advantage benefits, as in adding to what and reiterating what Mark's overview on the program, the 20% credit towards your closing costs, or in other words, additional out-of-pocket expense aside from your down payment, includes escrow fees, title fees, prorations, all calculated by escrow, which is roughly about 2% of the purchase price. As a side note, the 20% also applies when you sell with us, and will provide you with free marketing and staging, as well as assist you with coordinating, arranging some repairs needed prior to staging your home, known as the concierge service. So it's definitely an exciting time to buy in the Bay Area, especially with the rents increasing. So why not buy and take advantage of the program at the same time, having your own home to continue to increase in value, and in addition, have the tax benefits, and most importantly, have that personal happiness and just own in the Bay Area. The last thing that I want to mention is setting expectations between buyer and agent. We are here to help you achieve that and expect that. With all of the information available online, it's important to help you simplify and make sense of all of it. There's just so much information out there, and it's really important for us to be able to help you simplify and make sense of it. I will definitely help you navigate through the disclosures so you can better understand how to read through them and know what to watch out for. And most importantly, just buy your home at the best price possible. And we hope to be able to continue to be a resource and help you in the near future, and be able to navigate through the process. I'm available for your questions anytime, and my information is available, and you can reach me anytime. Thank you so much.
It looks like we have, we have a question Is the Home Advantage information on the SF Fire Credit Union website? And the answer is yes. So if you look under our home loan section, you'll be able to see more information about Home Advantage there. Or you could just use the search bar to search for it as well. Thank you for that question.
Do we have, I believe we had a couple of other questions come in, did we not?
Oh, we have another one. Oh no,
Oh.
she says thank you. Yeah, no, we answered the other ones, so just mark them as done.
Well, then what I'd like to do, I know that there were a couple of questions posed before the webinar, but just really briefly, I want to go ahead and talk. Frankly, it's my favorite part of these. So assuming that you get pre-approved, you get into contract, you find a home that you fall in love with, and you're going through the loan process. Wanted to talk a little bit about what not to do, what some of the roadblocks are, and I like talking about this because it's not necessarily something that's intuitive to people what those roadblocks look like. So I want to talk a little bit about what not to do once you get into contract. If we could advance, there we go. So it's not uncommon for borrowers to get so excited. So they find a property that they love. They get their loan approved. They're getting the appraisal done, and they think they're ready to go. But I will tell you, everything that I'm going to talk about are different steps that I've seen, or I should say missteps that I've seen borrowers take, and it could be as bad as delaying their close of escrow or entirely preventing them from being able to close on a loan. So when we have you get pre-qualified, and when we get you approved, we do that based on your current income situation, your current liabilities, and what that housing payment is going to look like going forward. So what that means is, don't get so excited that you're getting a house with a gorgeous garage that you go out and you buy a new car before that loan is closed. I've seen borrowers go ahead and do that, and then they end up no longer qualifying for the mortgage, and then they're parking their brand new, in this case it was a brand new Mustang, in the carport of their rental. Same is true. Don't if you've got fantastic credit and you've gotten qualified to buy a property and you're in contract, do not be the good guy and co-sign for your brother or your child or somebody else to help them get their new car. So same thing. There's an underwriting rule that's in place that says, absolutely, if you've only co-signed for somebody, you don't necessarily have to qualify them for that payment. The caveat for that is you then have to show proof of 12 months canceled checks or the like, that other party has made that payment consistently for a year. If you cannot provide that, if you've just recently done this for them, you will have to qualify as if that payment is your own. So be careful of that. What I talked about with the car, same is true for furniture and appliances. Don't put the cart before the horse. I've seen a borrower be so excited about moving into their new house that they went and bought a brand new refrigerator, and they were so tightly qualified. They bought at the very, very top end of what they could afford, and when they went out and bought all brand new appliances that they were going to swap out once they got into that property, they no longer qualified with that additional expense. And places do not take returns on furniture or appliances that you've taken delivery of. Something else to think of and have a conversation with your loan officer is changing jobs and moving money. So I know we talked a little bit about moving money. Don't do it. But there are some situations that'll come up. If you feel the need to move it from one institution to another, for example, if we've qualified you with and you need to bring in, this is a rough example, $100,000. and you've got 30,000 with us, 30,000 with Bank of America, 30,000 with Wells, and you go to close escrow, and now $100,000 is coming in from Bank of America, we then need to see that full paper trail for where that money came from to get into that account that then went into escrow to make that down payment. So if you do find yourself in a situation where you have to move money, keep very detailed paper trails for that, because your loan officer will need to see that. And then changing jobs. So when we get a borrower qualified, we certainly understand that there are situations where you may find a need to change a position. It's we're in a very transient employment area here. It's not uncommon for somebody to move positions. But again, if you're going to do that, have an open, candid conversation with your loan officers. We do not quit your job. Do not put yourself in a position where you are going to lose your job. Another example that I've seen, and I shouldn't laugh at it, but it's so absurd that I have to share it. I've had a borrower that got qualified, got the house that they wanted. Everything has gone through. One of the very last things that a lender does when they before they close that loan is they call to make sure that you are still employed. In this particular situation, we had a very chatty receptionist that said, "Oh no, they don't work here anymore. They got fired for starting a fight in the parking lot." So, there are a number of things that can trip you up in your home journey, your home purchasing journey. Just make sure that you're not doing anything that's going to hurt you in that journey. So just be careful of those roadblocks and speak openly with your loan officers. That being said, I believe there maybe have been a couple of questions that were presented before we began the webinar. Tatiana, do you want to address those for us, and we'll have Jeff moderate for us?
Absolutely. One moment, let me just adjust this here. Yeah, so we had a question come in just now asking, does San Francisco Fire do the pre-approval as well?
I'm going to go ahead and ask Grady to please answer that question. If he's off mute.
We will process the pre-approval. The pre-approval consists of a 30 to 40 minute online application, as well as income and asset documentations. So in an ideal scenario, we could process a pre-approval in as short as 1 day if we get everything we need to make an underwriting decision on your loan. So yes, we will help you with your pre-approval when you're ready to start shopping.
Awesome. And we had a couple questions submitted as well before the webinar. One of them was, how much should I have saved?
Ooh, that's a good one. Hey, Grady, would you like to field that one as well?
Yeah, absolutely. So that's a great question. There's no real right answer to that question. Depending on how much you're going to put down is essentially the answer to that question. But if you're trying to figure out where you're at, my advice would be to go forward with a pre-approval process, and we can look at different qualifying scenarios. For example, we could entertain a loan where you're putting only 5% down. And in that scenario, you're typically going to need about 9 months of reserves to qualify for the mortgage insurance. It's going to come with a 95% loan to value loan. In a scenario where you're putting 20% down, our reserve requirement is only 2 months. So that is a really positive competitive advantage of using us for your home loan financing, is you don't need a huge nest egg to buy a home once you have that down payment. And we also have the option to look at 10% down, 15% down scenarios as well. So we're going to try to cater your home loan based on your unique special needs and desires.
Okay, Great, thank you. And then another question that came in before the webinar, which we might have answered already, but maybe it would be good to just reiterate it. But the person was interested in knowing more about the cash reward. And I think a couple of stats that you quoted were that I believe it's 3% of the purchase price. And on average in the US, it was around $1,800 for the cash reward. So I think maybe Mark, if you wanted to talk about that one. Sorry, Jeff.
No, absolutely. Here's what I would say to that is on the website, on the web portal that I talked about, there's a calculator that you can use. And I really strongly suggest everybody try and go there. The calculator is great because it's all based on the price. And that way you can just go, you know, whatever the price of the house is, you can kind of see what the cash reward is. That way you don't have to figure out all the math behind the scenes, but it's going to, you know, roughly be a number of 25 to 3,000. I mean, we're talking jumbo loans. I mean, you could have those big $9,000 cash rewards. So use the calculator online. That's absolutely the best way to address it.
Awesome. And that's on the Home Advantage website, which you can get to from the sffircu.org site as well.
Yep, it's co-branded. So it's SF Fire branded. So
wonderful. Michelle or Jeff, did you have anything else before we close up?
I do not. I just wanted to thank everybody for the question, for listening, and then for posing questions. My favorite part of my job and the favorite part of my career is helping home buyers, and so it's always exciting to have engagement and have people begin their home purchase journey.
And I'll just echo that and say I really appreciate everybody joining us this evening. It's been a pleasure.
All right. Well, yeah, again, thank you everyone for attending tonight. This webinar will be available on our website likely tomorrow, but we'll be sending a thank you email out with the link so you can share it with your friends or family. I think we all learned a lot today. We learned about jumbo loans. We learned about some strategies for, you know, making an offer, working with Norlene and Mark at Home Advantage. So again, thanks for attending. We look forward to working with you and have a great evening.
Thank you.